As we're coming up on the halfway point of 2025, things were looking really optimistic for one high-yielding investment class in particular, which were real estate investment trusts. After underperforming for the past 3 years, 2025 was appearing to be the breakout year for them as the REIT sector saw some really good gains. Between early January and early March, the Vanguard REIT Index Fund, ticker VNQ, which holds 158 REITs across every major category of REITs, was up almost 7% in the first 2 months of the year. If we compare VNQ to the S&P 500, we can see that at the start of the year, it was basically side by side with the index, which is slightly unusual. Because after all, a large part of a REIT's total return comes from dividends and not share price appreciation, because they're required to pay out 90% of their earnings in the form of dividend distributions. They don't retain as much in earnings because most go to shareholders, so these investments don't normally see share price gains in the same way that other companies do. So these real estate companies were performing on par with healthcare, consumer goods, and automobile businesses at the start. But then starting in late February, REITs really started to shine as the S&P 500 began falling due to tariff drama. And for some time, there was a wide gap in terms of how real estate was outshining the overall market. But now moving forward to May, REITs haven't been benefiting from the surge in the market, and the sector is now down for the year when compared to the S&P 500. We can see that the S&P itself is up over 9.5% in the last month. But looking at a lot of individual REITs, you'll see that many of them have been falling hard over the past month. Realty income is down 3.39% in the last month, although they are still up for the year. Agree Realty is down over 5%, but they are again up for the year. This one has performed extremely well over the last year, and they're currently overvalued when looking at their price to AFFO. Triple N REIT is down 3.5% in a year, and Federal Realty Trust, the REIT with the longest dividend growth track record, has done terribly, being down over 14% for the year. So why have investors been selling their REITs over this past month, and especially in the past couple of weeks? There are 2 things that have been playing into how REITs have been performing recently. The first thing to keep in mind is that many REITs are considered to be defensive investments. Although there are many types of REITs that exist, the majority of them are seen as being safe havens compared to other investments within the REIT realm. We have self-storage REITs, multifamily apartment REITs, data center REITs, timberland REITs, and many others. Many of these companies, although not explosive in terms of growth, are likely to fare better during economic uncertainty. No matter how bad the economy is doing, people still need places to live, storage places to put their belongings, data centers to store the world's information, plus a lot of other things. Because of those consistent and higher than average dividend payments, when the market is facing uncertainty, it's not uncommon for people to pour their money into these investments. No matter how the market's performing and how share prices are moving, people are still going to look for dependable returns, which is where those dividends helped come into play. And what happened this year was that investors in general, whether they were very active in the market like day traders or fund managers with actively managed funds, found REITs to be a safer sector when it came to talks about tariffs. So what we experienced in the beginning of the year was a large inflow into these companies because many of the aforementioned companies would be less impacted by President Trump's tariffs. REITs don't sell goods, they own real estate and they lease their properties. Retail REITs have the potential to be negatively impacted by tariffs, but many aren't affected as much as a lot of other companies in the S&P 500. Things recently started changing though, as it became apparent that Trump was starting to pursue a different strategy with his tariffs. He started putting pauses on many of his original tariffs, and then on May 12th, it was announced that tariffs on China would be significantly reduced. In an agreement, the United States and China each lowered tariffs by 115% while retaining an additional 10% tariff as they continue their negotiations. What ultimately happened was that investors became more optimistic again. People were turning away from the more aggressive growth stocks like tech companies and putting their money into safer holdings like REITs because they were worried about the economy. But now that Trump is signaling that he wants to reduce his tariffs, at least temporarily, people have started putting their money out of REITs and back into growth stocks again. This is one of the reasons why this sector has been slowing down and seeing negative returns over this past month. But another reason why REITs have been falling recently is from the Fed announcement last week. On May 7th, Jerome Powell again announced that interest rates would remain unchanged. Although it wasn't surprising, it was still a negative thing for REITs to experience. As I mentioned many times on this channel, these investments move inversely to interest rates. That's because REITs frequently use debt to do things like acquire more properties or make upgrades. So when interest rates are high, REITs go down, and when rates are low, then these investments become a lot more attractive. The Federal Reserve hasn't been as optimistic about the economy, and they've been taking longer to cut interest rates than what we were originally hoping. When they do start cutting rates, then that will result in the REIT sector becoming more attractive to investors and share prices will rise. But until then, or until enough time passes, many REITs are just going to continue to move sideways. Of course, every now and then when we talk about the performance of REITs, a really important fact needs to be brought up. On a regular basis, I'll see comments being made about how these investments are poor choices. Some will say, why would anyone want to invest in REITs? They've significantly underperformed the S&P 500, and in fact, look at Realty Income. Its returns have flatlined over the past decade. It's a terrible investment. And I always have to point out a few facts to these people. The first is that Realty Income isn't the only REIT experiencing this. It's widespread across many of these companies. Triple N REIT, Federal Realty Trust, Simon Property Group, Public Storage, and many others all have similar returns. Interest rates started going up in 2022, and during that time, REITs were still recovering from COVID. Rate hikes immediately interrupted their recovery. For Realty Income, it was literally right about here when rates started going up. As soon as rates get reduced, then REITs will begin to grow in share price again. Second, Realty Income and most REITs have continued to expand their portfolios. This company has nearly doubled in size since the beginning of the pandemic. So what do you think will happen to its share price when we do get rate cuts? It's going to rise to even higher than its all-time high before COVID, assuming there's no corporate scandals or a depression doesn't happen. That will be the case for many REITs. Third, people often look at just the share price chart and they don't account for total return, which would include the dividends. Many equity REITs are yielding between 5 and 6% right now, and it's crazy how so many people never account for that when they think about a stock's return. If you have any dividend stock that's yielding 6% and it only moves up about 3% in share price per year, then that stock is beating the market's long-term yearly return average. But the absolute most important thing about this argument is this. You should not expect REITs to outperform or oftentimes even match the S&P. If you're buying REITs with the expectation that they will beat the market over the long term, some might, but the majority will not. That's not the reason why these investments exist. REITs were designed to allow people to invest in real estate more easily and collect a share of the rent profits in the form of a cash payment, aka a dividend. These are stocks that are supposed to provide regular distributions for the purpose of lifestyle expenses or reinvesting back into buying a larger ownership percentage in the REIT. Many REITs can outperform the market during specific periods, but if we're talking about over the course of several decades, then you should not expect the majority of these companies to outperform the S&P. You should buy them for the dividends first and share price appreciation second. So if you're concerned about REITs underperforming or selling off, just know it has nothing to do with the sector in general. People who were more defensive are now rotating out of REITs. That's the number one reason for them falling. These investors never intended to buy them with the goal of living off dividends, like I hope you are. Make sure that you're buying REITs for the right reason and you're using this opportunity to pick up more shares of your favorite companies now offering a higher current yield. But with all that being said, thanks for watching today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.